Today on Chart This with Gary Wagner, we're going to take a look at gold going over the $1,300 mark and more coming up. And with me now is Gary Wagner. Gary, thanks for coming on today.
My pleasure as always.
All right, Gary, so gold's had a good run so far in 2014. We saw it break the $1,300 barrier last week. Now, do you think this signifies the end of a bear market?
It certainly signals a major change in market sentiment. Of course, the comment that I was making over the last 3 weeks is that if we cross this long-standing resistance line on a technical basis, we should see a breakout. And typically when you see a breakout, you will get not necessarily a parabolic rise in the market, but you get a sharp, distinct rise in price. And we really didn't see that a couple weeks ago. Last week we did see that. We actually saw not only the market break through 1,300, but do it with a fever. On Friday it was trading roughly at around a high of 1,321. My number right now has been 1,329 that I believed it could hit. And my sense is that you've had a fundamental shift in market sentiment.
Right, so last week we had Janet Yellen speaking for the first time. Then we saw gold and equities rally together at the same time, which is a little odd. We don't usually see that. What do you think of that, Gary?
Well, that's absolutely correct. It is a fairly rare occurrence to see gold and the equities markets run in tandem, although we do see it. And one of the notable characteristics that can be in play in the market when something like this happens is that after Yellen spoke, the belief was that tapering might not end as soon as had been previously believed, perceived, or assumed. And so those assumptions go into the models that we create to try to forecast price. And so when the variables of the model change, so does our basic outcome or outlook. And what we've really seen is a shift in sentiment in which you've got the dollar under pressure, you've got equities up, and you've got gold up. And that tends to happen only when you have a scenario in which you're looking at the Fed as being continuing its loose monetary policy.
Right, let's stick with that. Now, we've been seeing employment numbers come out as well as other data that seem to be disappointing, not meeting expectations that analysts have put out there. So the recovery seems to be stalled or maybe not happening at all, according to some people. Now, what are your thoughts on this?
Well, in terms of sentiment itself, the economy is absolutely improving. The question is, how quick is this recovery really coming along? And so we look at employment or unemployment numbers to give us an indication of the speed and the complexity of the recovery that we're currently in. Now that's going to go through peaks and valleys like anything else. And it is right now my belief that we are definitely in a recovery. The recovery is on track. It is not taking place as quickly as many might have liked to seen it, but we're on track. We're not in 2008 anymore. We have a totally different, vibrant economy. And it does slow down and it does speed up, but the key is that we're out of the real tails of the recession that really gripped the global markets 2008, 2009, 2010. We're in 2014, and at this point we're looking at how quick the recovery will take place, not whether or not we're in a recovery.
Let's wrap up with gold in that $1,300 territory now. What numbers, what key numbers are you looking at moving forward?
1329 is an important Fibonacci number. 1365 is really the number that I'm looking at, and then of course 1435. I don't think we'll see a straight ascent. I think we'll see one step forward, a half a step back, and one step forward. In other words, that stair step up. However, when we touched upon this a little bit last week and the week prior, the only other time we've seen this market at 1180, 1186, that double bottom, in the last occurrence, which was June of last year, we saw the market run to 1435. It came down, and when it came down, the next high it hit was 1365. So those are the two tops. If we see this market continue on an upward track, those are the two areas that I'm very interested to see how the market reacts if and when it gets there.
And Gary, what have you brought for us today?
Well, that's a good lead-in, because the insert that we're going to be airing today talks about the breakout. We have finally gotten confirmation of this breakout that we were looking for over the last month, and now that it's in play, I want to enlighten our viewers as to key areas to look at and possible strategies to play within this marketplace itself.
All right, Gary, let's take a look at your inserts.
On today's video, I want to explore a couple of things. I want to explore first our current model that we're looking at in terms of our Elliott wave count. We had two basic models that we have been kind of juggling back and forth to see which one would unfold, and I think we've got some pretty conclusive evidence that one is much more likely than the other. We'll talk about that on today's show. And then the other thing that I want to talk about is the pure power of trend line and resistance lines, support and resistance lines, and how they can really shed some incredible light in terms of the future movement of gold. Now, we're recording this on Sunday evening, approximately 7 o'clock in Honolulu, which means that it has opened approximately 6 hours ago or 6 hours ago in trading over in Sydney. It has gone and is in Hong Kong, not yet reached London. But as we look at this chart, and I want to start today's insert by kind of looking at a daily chart and talk about what I believe to be, at least now, some fairly strong evidence that what we have witnessed, in fact, is a breakout above this long-standing resistance line. 1800 here, it's the last time the market ever saw this price, and of course this is October 2012, all of 2013, 2014 here. We talked about the fact that we could create, and I'm going to draw it as straight as I can, we could create a long-standing resistance line, and these resistance lines would basically form an angle that tacked the angle itself we would get from these series of highs that we had as the market was dropping, and then of course all we're doing is simply extending it in that direction. We also talked about the fact that the last two times this market has really approached this long-standing resistance line, it was met with really, really strong resistance, and this would give us our real strong indication that we were, in fact, at a top in the market. First time this happened, of course, was the major rally we had of 2013. This is when we go to our low for the first time of this double bottom. Bottom here, this is our double bottom, but the first time that we reached it, market comes up, starts at 1181 the low, and then really falters, I believe, at about 1435. And so the interesting thing is the fact that it happened literally within just very, very close proximity, of course, to that long-standing resistance line. Then the next time that happened, this is the market hits this top, comes back down, and we get a higher low as this market it's moved down, and we get this higher low. This low being at, I believe, at around 1250, 1260, and from that point tries to take yet another stab at this long-standing resistance line. And lo and behold, it comes to the line and breaks down, and that's where we got our double bottom, because of course once we hit this low at 1186, and it bounced off, well, that was our first real indication, the fact that we had these bottoms occurring, and the fact that it went to this low and didn't go lower, because if you recall at this time, many were calling for $1,000 gold, $800 gold, the sky was falling in, things of that scenario, but this turned out to be a pretty substantial bottom, and we tried to make Chartist viewers aware of this over the time period that this occurred right down here. But we did it with a caveat. We did it with a really strong level of caution. And the level of caution was that on the last two occasions, what we had seen is market come up and then come down. Market come up and then come down. So until we strategically broke through this particular long-standing resistance line, I was reluctant to say that we were out of the muck and that we were going into some sort of a bullish rally. Now, it's my belief, and we'll talk about this when we talk about the wave count, but it's my belief that this is probably a counter trend rather than a full-blown bullish rally, meaning that we're back into a bullish cycle. That's another discussion. However, we did notice that there was a real distinct difference in the market as it came up. At first, let's go ahead and draw this in again, but at first when we saw this market come back up, and this was yet, a couple of weeks ago. Interestingly enough, when we looked at it, the market came back up. This, of course, is a daily chart. It came back up, it closed above there, but it then started really running in the muck, meaning that we didn't get the kind of breakout that I was looking for, because my belief is that on any kind of a compression breakout, and a compression breakout, the easiest way to describe that is you get a series of lower highs, and then you get a series of higher lows in which that range gets smaller and smaller, tighter and tighter, and when it hits that apex, when it hits the top of the triangle, it usually, as the theory goes, releases a lot of energy, and that release in energy, of course, that dynamic release will get you really a sizable breakout to the upside. Well, we absolutely didn't get that when I expected it. But then things don't always occur that way. Rather, what we saw was it traded around this area, but we finally did get our breakout over the last couple of weeks. And look at how dynamic it's been, because this market just steamrolled through $1,300 at the end of last week, and it's been on this tremendous flight. As I said, currently trading at about $1,324. Well, where do we think this market is going to go? And where are we projecting our current top? And really, for that, because of time permitting, I'm going to put that on the after the show content. This is how you join the after the show membership. It's absolutely free. When you go to the website, what you'll see on the front page is an area, Chart This After the Show, where you can actually go and sign up. We have created a members role for the Chart This After the Show. You will have to be a member. Membership is absolutely 100% free. When you click this, what will happen is it will take you to your sign up page, which is just like this. And all you need to do is click this button, create your username and password, and then you'll be able to log in and view the bonus content for this week, as well as all the following weeks, have access to our forum and our gallery of charts. Again, trend analysis, Elliott wave, Fibonacci, as it pertains to the price of gold. And I do want to thank you, Chart This viewers, because I think that by allowing us to share some of this technical information with you, hopefully it's given you great insight, and you were able to take advantage of this last move that we took a look at and forecast over the last 3 weeks. Bye-bye.
And thank you for that, Gary. And thank you for watching this edition of Chart This. If you have any comments or questions, please don't hesitate to send them to newsfeedback@kitco.com. Also remember, Daniela will be in Fort Lauderdale on February 23rd doing Gold Stock Analyst Investor Day. Make sure you check that out. Have a good one.